Hey everyone, this is Kirk here again at Option Alpha, and in this video we're going to walk through a bull put spread break-even price calculation. You might also hear people call this a bullish credit spread as well. Also a short put spread. It's another common name for this, but the end result is that it's all basically the same stuff. So a bull put spread or a bull credit spread or a short put spread or a short credit spread. I mean, there's all kinds of different ways you can say it. But essentially what we're going to do is going to go through exactly how to figure out and calculate the break-even price. So we're just going to use a very simple payoff diagram structure, which is here. And what we need on top of this is we need the payoff diagram for the bull put spread. So this is the payoff diagram for the bull put spread, and it looks like this. And you can see it has defined profit on the top side, and it has defined risk on the bottom side as well. And it basically pivots at these 2 points here. Now these 2 points here are where you sell the different contracts for this bull put spread. In this case, you would be selling one put option at a lower strike, say 90 as a strike price, and you would buy another put option at an even lower price than where you sold this put option at. So let's say you bought this one here for $85. So you sold this one at the 90 strike, you bought this one at the 85 strike, and now what we have to figure out is we have to figure out what this break-even point is. Now the way that you do this is actually fairly simple. All you're going to do is you're going to figure out what the net credit is between selling the put option here and buying the put option here as part of your spread. You need to figure out what that net credit is that you collected. Now, since we're doing a bull put spread, we usually collect a credit on trade entry. So we're going to use that credit to calculate our break-even price in a second. So let's assume that we sold the first 90 strike put credit spread for a $3 credit. So we collected $3 in premium, and we had to use some of that premium to buy the 85 strike put option here. Let's assume we had to use $2.25 to buy that put option. So we sold the 90 strike put option for $3. We used part of that $3 premium, $2.25, to buy the 85 strike put option, and that leaves us with a total credit of 75 cents. Now that total credit that we collected not only is just our max profit, but is also a way that we can use that credit to calculate our break-even point. So the break-even point is essentially calculated doing the following. You take your short strike here, which is the 90 strike option, 90 strike price. You subtract from that 90 strike price the credit that you collected, which is here. So in this case, we subtract 75 cents, and then the resulting answer is our break-even point. So in this case, that would be 89.25 would be our break-even point. That is the price point right here. And you can see it's always less than the initial strike price here at 90. So if we just draw like a dotted line here, you can see that that data point here is the 90 strike. If this data point here is the 85 strike, and we're trying to figure out something in between, that's our break-even point, we just take the 90 strike short contract, subtract the credit that we received, which is 75 cents, and that gives us our new blended break-even point of 89.25. So essentially what that means is that as long as the stock trades anywhere above 89.25, then we should have an opportunity to make money at expiration. So when you get into these contracts, usually the stock will be trading higher. So let's say the stock's trading up here at $95. You might still sell the 90 strike put, buy the 85 strike put to create this bull put spread. But if the stock actually goes lower, this is where calculating that break-even point can help, because technically the stock can go all the way down to 89.25. It could potentially close just above that level, and you still have an opportunity to make money at expiration. So hopefully this helps out. As always, if you guys have any questions, let us know. And until next time, happy trading.